Today we're going to be going over put options. If you don't know what put options are yet, then you're definitely in the right place. I'm going to be teaching you what they are, how they work, how we can make money from them, as well as some real examples. In the two previous videos in this options tutorial series, I first taught you what options are, and then I went into call options and explained those in depth. We went over some real examples of call options, and I told you how to make money with those as well. If you haven't yet watched those first two parts, I'd highly recommend you do that before or after watching this video. A lot of the concepts are very similar and will help you going forward. So let's dive into the content. Just like call options, put options are one of the two most basic ways that you can purchase options. And if you don't know anything about options, they're a way to leverage moves in the stock market and make way more than you would by just buying or selling the stock itself. Call options are betting on a bullish move in the market or the price moving upwards, and on the opposite side, put options are betting on the price moving bearish or downwards. So before we dive into some examples, it's important you know what you're actually purchasing when you're buying these options. As I told you in the previous video, with call options, you're buying the right to buy 100 shares of the stock. Put options are the exact opposite again. You're buying the right to sell 100 shares of the stock at whatever strike price you choose before whatever expiration date you choose. So the strike price is just the price at which the shares are traded if the contract is exercised. That's a really important definition to know, and you'll see that come up once we get into our real example. So since I know real examples are much better than just throwing a bunch of words and concepts at you, let's get into one right away. I've scrolled TradingView back in time to August 3rd here, around 10 o'clock in the morning. If you're also using TradingView, you can do the same with this replay feature up here. You can go back in time to whenever you want, and you can even simulate the candles in slow or fast movement forward. So we're going to be simulating this as if it's actually August 3rd now. Let's say you looked at this chart, you saw Apple spiking upwards by a ton here, and you thought that the price was going to go downwards, at least in the short term. Over the course of about 10 days here, we went from about $90 all the way above $110. So let's say you think the price is going to go back down to about $100 before we can start going up again. Just a natural retracement in the market. To bet on this bearish movement, you would open a put option, and more specifically, you would buy the put option. Let's open Thinkorswim and see what this would look like. Now, just like in TradingView how you can go backwards in time, Thinkorswim allows the same thing with this on-demand feature. You can choose a date in the past and a time, and it'll show you real time what the options prices actually were. Now, the only downside to TradingView's replay feature is that when a stock splits, it doesn't actually show the previous price history. So at the end of August, Apple's stock actually split 4-1. What that means is they multiplied their number of stocks by 4, but decreased the price by 1/4 as well. So when August 3rd was actually happening, Apple's price was actually 4 times this. It was around $440 on this date. And so although I mentioned that we think it's going to go down to $100, just remember that on Thinkorswim, they're actually using the real prices back then, so we're going to have to look for the $400 contract. I know this is a little bit complicated. You don't have to actually worry about this when you're buying or selling options, but if you're going back in history to backtest, you'll want to make sure that you have in mind a stock split. Now, if you do forget, as soon as you open Thinkorswim, you can see the price of Apple up here is $444, which, as I was saying, is 4 times this $110 price range because the stock split 4x. So when you have Thinkorswim open, on the left-hand side here, you're going to see all of the call options that are available to you, and on the right-hand side, all the put options. Depending on which broker you're using, it might be slightly different. So let's just scroll down to that 400 put option on Apple that we were just talking about and look at the price of it. So there are a few key things you need to note when you're looking at this. The first one you can see here, all the way on the left of the put option, is this August 7th, 2020. This is the expiration date, and this is the day that you're allowed to exercise the contract before. Once August 7th passes, this contract no longer has any value at all. The second thing here is the strike price. This is the price which you can actually exercise at. So if we're buying the 400 put option here, that means we can sell 100 shares of Apple at $400 anytime before August 7th, 2020. What's really important to remember is that number that I just said, that it's 100 shares. There's an options contract multiplier that's implied that you absolutely need to know and be aware of, and it's 100 shares. Each contract states that 100 shares can be transacted and not one. And that 100 comes into play when we're actually buying this contract as well. So for this one, the bid is 38 cents and the ask is 42 cents. So if we go to buy this contract, a good price to set would be this 40-cent range, right in between the 38 and 42. Then we're most likely to get a fill. As soon as I click confirm and send here, a dialog pops up and it tells me the cost of the trade. And now you can see the trade actually costs $40. This is because of that contract multiplier I was just talking about, where when you're buying a contract, you're actually buying the right to sell or buy 100 shares of that stock. So that same multiplier takes into effect when you're buying the contract. Even though it looks like it costs 40 cents, you need to multiply that by 100 to get $40. So let's go ahead and buy this and see what happens. I'm back on TradingView here and I'm simulating the price outwards, just a bit. Remember that we bought the August 7th expiration, which means that right about here, at these few candles in here, the contract goes worthless. We know that our contract was a $100 put, which gives us the right to sell Apple shares at $100. However, let's just think about that and think about the value that would have. If Apple is $110 at the end of our contract, why would we want to sell shares of Apple at $100? Obviously, selling at that $110 price point would be much more beneficial to us. And as a result, if we go forward in time to August 7th at the end of the day, and I'm just changing the time here in Thinkorswim to August 7th at 2 o'clock p.m. Eastern Time, look at these $400 puts now. They're worth essentially nothing. There are two super important things to understand about how the value of a contract actually comes, and their intrinsic value and extrinsic value. Intrinsic value is the real value that the contract actually had. Let's say that Apple had dropped to $95 before that August 7th expiration, all the way down here. Because we have the right to sell at $100, our contracts actually have a value of $5 per share. In other words, if we were to execute that contract right now, we would be able to sell at $100 per share, whereas Apple is only $95 per share. So when you multiply that by the 100 shares, that would make the contract worth at least $500. The extrinsic value is the other side of the value of the contract, and it's what is known as the time value. When we bought these contracts, it cost us $40 to buy, and that's because it was 4 days before the contract expired. We were basically buying the time on this. Since we had 4 days for Apple to go below $100, the extrinsic value, or the value based on the probability it was going to go below $100, was that $40 cost that we had to pay up front. When a contract is out of the money or currently has no intrinsic value, extrinsic value is the only thing driving the price. And we can call that price that we paid the premium. Basically, the person who sold us the contract needs to have some reason to sell that contract. They need to get some value out of it as well. Otherwise, they might just be giving us this really good potential deal with nothing for them. I want to show you one more example here, and that's of Apple on September 1st at the end of the day. Let's say, again, Apple was on a major run here, and you thought we were just about to peak. You're looking for put options because you believe the price is going to go downwards. So Apple is currently sitting at $134, peaked around $135. Let's say you just think the price is going to go down to $130 by the end of the week. So let's open Thinkorswim and open a $130 put on Apple that expires at the end of the week, September 4th. I have the September 4th expiration date chosen, and we're looking for that $130 put, and you can see it costs right around 90 cents for the contract or $90 for the order. Let's go ahead and purchase that. And now once again, let's simulate forward to the end of the day on September 4th. Okay, so I fast forwarded TradingView here. Now we're at the end of September 4th. It's about 14 o'clock on this TradingView chart. And remember that we opened a put option at this $130 price range. This time we got our technical analysis correct, and Apple actually did dip significantly after we opened our put option. So when we opened the contract, it had no intrinsic value because it was above $130, and the $90 we paid was fully extrinsic value. But now that time is ending at the end of the day, September 4th, the extrinsic value of the contract approaches $0. So let's take a look at what the intrinsic value is. And as you can see, these contracts are worth about $11.5 right now, or $1,155. We only paid $90 for this contract, and so it's clearly more than 10 times its value from when we bought it. Now let's take a look at the math on the intrinsic value of this contract and see why it's worth this 11.5. The price of Apple at this point in time is 118.6. And remember that our $130 put option, once again, allows us to sell 100 shares of Apple at $130. In other words, we should profit about $11.40 for every share of Apple that we sell. Just $130 minus this $118.60. And you can see that 11.4 value transfers over almost exactly. Our contract is only worth slightly more than that since there's a few hours left in the day, so we have a little bit of extrinsic value, but almost all entirely intrinsic value. So just to recap, this $15 move downwards in Apple produced us an option that's over 1,000% higher than when we bought it. This shows you just how powerful options can be in leveraging the market. If you like this video and want to watch the next part of this options tutorial series, make sure you click that like button and hit subscribe below. I really appreciate all of your support.